heavy revenge guaranteed. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investment related to Asia. Many of you asked me about the market crash of the technology companies from China and the regulatory crackdown. What should we do? Is it going to spill over to electric vehicle companies like BYD, Nio and Xpeng? I'm going to share with you my thoughts. Things are moving quickly day by day, as you all know. As of 14th of July, we see some rebounds of the share prices of Alibaba, Tencent, Bilibili, JD.com and etc. Why? The trigger was that Tencent received approval from Chinese regulators to acquire Sogou, the second biggest search engine in China. For many, this symbolized that the end of the regulatory crackdown. But is it true? On the other hand, major investors are selling Chinese technology stocks, for example, ARK Invest. ARK's innovation ETF has only 1% worth of holding in Chinese technology stocks compared with 8% in February. The other fund of ARK Invest, ARK Innovation ETF, has only 5.4% of holding in Chinese technology companies, the lowest since October 2014. Amid such confusing signals, there are main questions to be answered. First, what are the implications to Chinese technology companies? Secondly, what are the implications to IPOs by Chinese companies in the US? And the third is, will it spill over to electric vehicle companies like BYD, Xpeng and Nio? The fourth is that, what is my strategy and approach towards this kind of situations? Regarding Chinese technology stock, if you pay attention to the news and some of my videos, you will know that there are numerous of crackdowns from the Chinese regulators. In fact, the most shocking one was the cancellation of IPO of Ant Financial, which is controlled by Jack Ma, the founder of Alibaba. It was supposed to be the biggest IPO in the world in the whole of 2020, and it was cancelled last minute by the regulator. And then, of course, in recent days, Didi, Cantun, and Food Truck Alliances, all of them recently listed in the US and are subject to crazy crackdown by regulators in China. If you want to know more information about the crackdown, go to check out my videos on Alibaba and Didi. Just go to the channel page, click subscribe, and also click the bell button so that you're not going to miss out the new videos as well. Okay, back to the topic about the crackdown of Chinese technology companies. Most of the regulatory props focus on antitrust behaviors, like on Alibaba, Didi, or Meituan. Alibaba got fined a world record sum of $2.8 billion. Sounds a lot, right? But actually it's quite tiny compared with its overall size. So it doesn't have a huge impact on their overall revenue and performance. Despite the fact that even a huge amount of fine have little effect on this kind of mega-sized company, the introduction of competitive behaviors would have high impact on their growth. This in turn means that they cannot have high valuation as they did before, at least not the high PE ratio, price to earnings ratio, or price to sales ratio as they did before. I'll expect a continuous volatility in the coming 6 to 9 months until there are more clarity about the penalties and about the new regulatory regimes. So how about Chinese companies' IPOs in the US? First of all, many of the companies that plan to list in the US have stopped or postponed their IPOs until they have more clarity about the Chinese government's attitude. Secondly, for Chinese companies that recently had their IPO in the US, for example, Food Truck Alliance or Cantun or Didi, there will be a lot of volatility in the coming few weeks or 2 to 3 months because of the entirely new category of regulations related to companies listing in the US, national security. In fact, as recent as a few days ago, the Chinese government released a new rule regarding data security and national security. It requires all Chinese companies that want to list overseas to seek its approval if they have data of more than 1 million Chinese citizens, which is a threshold that is quite easily exceeded in China given that most of them have hundreds of millions of users. let alone that the Chinese government is also looking at these companies regarding their data security and collection of personal information back in the country. But Didi is the worst because it's involved in both antitrust probes and the data security probe. The worst thing is that they went to IPO despite the warning of the Chinese government, so heavy revenge guaranteed. Putting Didi aside, the Chinese companies that recently had IPO in the US, as long as they are not a tech giants with monopoly and with data of hundreds of millions of Chinese citizens, I think they should be fine because they just need to comply with the data security requirements instead of being broken down for antitrust behaviors. I don't see there's a huge problem for them. So how about the implications to electric vehicle companies like BYD, Xpeng or Nio? The good news is that it is extremely unlikely they will be subject to antitrust behaviors, at least in the coming 5 years. The biggest one, BYD, produced 32,000 electric cars in May, and they've produced 110,000 electric vehicles in the first 5 months. Assume that they make it to 300,000 electric vehicles for the whole year. It is still minuscule compared with the 20 million car sales in China every single year in the past few years. So how about data security regulations? It's also very unlikely. Why? Because the main business of these EV companies is to produce cars. Of course, they are software and they also collect some data, but it's nothing comparable to Alibaba, like they have Alipay, or Tencent, they have WeChat super app.
They know what to eat, they know where you go, they know what you buy, they know how much you earn, and even your credit rating.
So compare with that, the risk of being regulated on data is extremely low compared with this kind of technology companies. However, there will be two major risks that will bug Chinese companies listing in the US in the coming 2 to 3 years. The first risk is that the Chinese government actually do not like the businesses to raise capital overseas. What's the reason behind? Well, because most of these companies explore a loophole using VIE to circumvent Chinese government's control on foreign investment into Chinese business and also on raising capital overseas. Why do they so afraid of raising capital overseas? Because then they would be subject to the control of the US government if anything happens. The second risk, even worse still, is that actually US also do not want Chinese companies to list in the US. At least some of the more hawkish politicians like Senator Rubio. There are two reasons. The first reason is pretty obvious. They don't want to use US investors' money to fund the expansion of a Chinese company or to develop their technologies and then to compete with the US. The second reason is also about protecting investors in the US. Until now, the Chinese companies listed in the US are not subject to the same auditing rules as the local companies. That's why last year Donald Trump signed an order requiring Chinese companies listing in the US to subject to the same auditing rules as other companies listed in the US. If not, these Chinese companies would be delisted from the US stock exchanges. But China never agreed to have Chinese companies to be audited by foreign governments so far. It means that in the coming 2 to 3 years, with the increasing tension between China and the US, there's real danger that Chinese companies listed in the US will be delisted, and this will include electric vehicle companies. This will have huge impact to the share price, even just the rumor itself. Okay, so what is my strategy then? I will focus on short term. What I meant short term is 6 to 9 months. I expect that the Chinese tech stock, as well as the recently listed companies in the US, will have a rebound once there's more clarity about the regulatory probes. And then I will sell them within the coming 6 to 9 months as long as they reach my target. But I'm not going to hold them 2 to 3 years, which is the typical duration that I would do for other investments, because there's a real risk that they will be delisted. And even just every time getting closer to be delisted will inflict a huge loss on their share price. How about long term then? I'm talking about 10 to 15 years. As Mayo Das, an equity strategist from Morgan Stanley, recently said, it's actually quite cheap to buy really good Chinese companies now if you're holding it for at least 10 to 15 years. Of course, we need to pray that they're not delisted. I know that many of you like to quote the success story of Amazon, right? But you need to note that there are more companies, probably 95% of the companies failed in the past 20 years. And Amazon, of course, is a poster child, but this is the exception. Also, you need to know that the situation in China is totally different from the US. It is not a free market economy. So you need to take note of these two risks if you want to invest long term. Apart from this topic, do you have any particular topic you want me to talk about? Leave me in the comment below. If you like the video, remember like it, share it, and subscribe. Even better, clicking the bell button next to the subscribe button so that you're not going to miss out. This will be great motivation for me to continue making better videos for you guys.